Hey everyone, happy Thursday, September 7th. It's about 10:45 on the West Coast and time for another market update. A pretty light week in news this week, but going back to last Friday, remember we got the August BLS jobs report. And this is always very, very important because the Fed is paying close attention to this and they're the ones making all these decisions on these rate hikes. So, came in at 187,000 jobs created, 170,000 were expected, so it beat the number there. Unemployment rate jumped, but I'll explain that more here in a second. So taking a closer look, remember there's two different parts of this. There's the business establishment survey, which is where they kind of use math and projections to come up with these numbers. Like I said, it beat the number, third month in a row under 200K though. But the big thing I want to talk about is more negative revisions. June was originally 185,000. They negative revised it down to 105. In July was 187,000. Now it's 157,000. So 110,000 of negative revisions the last 2 months. They're very well will negative revise this current number of 187. And like we talked about, that's frustrating because the markets react to this initial number and not so much to these revisions. The birth death model, which basically businesses created, employees created, and then businesses closing, employees lost, that's still showing 103,000 gain, which is a little unusual given the current market and credit tightening. And then if you take a look at the averages, 2022, there's about 400,000 jobs created per month. The last 12 months, about 257, 6 months, 194, and the last 3 months now, 150K. So you can see that's deaccelerating. So that's a sign of some, the job market at least slowing, if not weakening quite a bit. And then looking at the household survey where they actually call folks and talk to them, that's where the unemployment rate jumped from 3.5 to 3.8. But that was mainly because this total labor force jumped, 736,000 jobs. So it wasn't necessarily more people losing their jobs, but more people looking for work. So that, again, doesn't scream strength. And then, if you look down here, part-time economic reasons. So people going back to work part-time because they need the money jumped 221,000. Full-time drop, part-time jumped. So basically shows that, again, not strength in the job market. People having to go back to work, people having to get second jobs. That doesn't scream everybody is doing great. So hopefully the Fed's paying attention to that. And then the last thing with this report, duration of unemployment is going up. So, less than 5 weeks at 217,000, so more people there. But then you get into 5 to 14 and 27 plus weeks. That's a lot of people staying on unemployment longer. So that, again, is something that shows that people are having a harder time finding jobs once they do get out of work. So again, not a point of strength for our job market or our economy. Next thing we got initial job claims today. That was supposed to be 216 or 234,000, came at 216, so a miss, not good. But then keep in mind it was Labor Day week. A lot of people are coming back from vacation, so a lot of times the numbers on holiday weeks are going to be less. But still, it shows that the job market still stays tight. People are trying to keep their employees when they can, and not a lot of jobs like we talked about for people when they are out unemployed. Purchase apps down -2% last week, -28% year over year. High rates, not a lot of inventory, doing a number on the mortgage industry. Miscellaneous stuff. So Fed speakers all this week, a couple more today. We have the Fed, different chairs and governors are speaking about what they think, about the economy and just whatever they feel like talking about, I guess. And so far the message has been basically inflation's coming down. They got to be careful. Job market's still strong. Most of them seem to be indicating they're on board with a pause here coming up in September. But then going forward, there's been some murkiness, in the November and the December meeting, what they're going to do. And then the other thing I want to point out, credit card debt delinquencies. So, we've talked about, credit card debt's over $1 trillion, highest it's ever been in this country. The average rate on these credit cards now is over 25%. So that's all not good news. People using their credit cards too much, personal savings going down. Now we get data that's showing that the, 30 and under and 40 and under folks are going delinquent with their credit cards. Or 30-day lates and 90-day lates are jumping quite a bit. And that's not good. Obviously, that shows that they're having to put stuff on credit cards or falling behind. That doesn't scream strength for our economy. Eventually, they'll run out of credit cards and credit card usage, and that will hurt sales and stuff like that. And then also, these are the same folks, 30 and 40-year-olds under, are the ones that have student loans. And student loans, remember, they're going to have to go back in repayment here shortly. So those same folks that are already falling behind their credit cards are going to have a new $300, $400, $500 payment every month they have to make. So that is all deflationary. Not good for these folks, but it will slow down the economy. That's something that, they don't have that money to spend. They're not spending it on other stuff. That trickles down to everything, so that's something that's deflationary, at least in the fight on inflation. That's a positive. And then the next thing, average 30-year conventional, that jumped from 7.07 to 7.33, almost over a quarter point in a week. That had a lot to do with these Fed speakers. That do some, there's some worry over in China about how things are going over there. And then also we had some strong manufacturing data, which kind of, that's something the Fed looks at and says, hey, manufacturing is going strong, the economy is going strong. So that's something we have to keep an eye on. And then important dates coming up. We got inflation next Wednesday is when I actually will do my my update for you guys, because I'm going to be traveling on Thursday, and so that's always important. And we take a look at the inflation data, and then the Fed the week after, the Wednesday after that, the Fed will be meeting and deciding. And like I talked about, it's about 93% chance right now they're going to pause, which we want. But then you look at the November meeting, beginning of November, that's about 53% chance pause, and the rest be some sort of hike. So we don't want any more hikes. We want pauses and we want cuts. We don't want any more hikes. So we're going to have to keep an eye on the Fed and see what they're doing. But, like I said, tough times now with rates high, not a lot of inventory out there. People that can't afford housing, still a great deal to buy a house. And then, with all this credit card debt, all that stuff going on, if you or anybody is sitting on a ton of debt and they're getting stressed out about it, and then they're a homeowner, they have a lot of equity, remember, even if your mortgage rate goes up and our payment goes up quite a bit, if it's offset by how much you're saving in your car payment and your credit card, student, whatever you are paying off with the money, that's a good deal, and it's amortized over 30 years instead of like some of these 25% rates you're carrying, debt on right now. So just something to keep in mind. But if anybody needs anything at all, please don't hesitate to reach out, and I'd be more than happy to help. Have a great weekend, everybody.